Hello and welcome to episode 476 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm good. Well, I say I'm good. You'll probably notice my voice is starting to go because it's autumn. I think I'm coming down with a cold. And anyone who follows us on socials will see that I had my infusion this week for my Crohn's. So that always knocks my immune system slightly, but particularly as we go into the autumn. So apologies for my voice sounding a little bit off, but we will soldier on. But apart from that, been good, Andy. Busy week, especially on the socials. We've done a lot of good stuff and some stuff that's actually become very popular, things to do with interest rates, a few jokes and memes in relation to sharing your finances and how to better share your finances and work together if you're a couple. So do make sure you go and follow us on Instagram, TikTok, and all our social channels, including YouTube. So I'll put that at the front of the podcast for once rather than at the end. So I'm going to crack on actually, Andy, and tell you straight away what's going to be on the show this week. So 3 pieces. The first one is in relation to the budget. We're going to be doing the predictions of what is going to be in the budget. And now I don't normally do that. I don't speculate. Anyone who's followed us for years will probably notice there's a definite rule in Money to the Masses that if something is speculation or might happen, we don't tend to cover it because it confuses people. I actually like to focus on the actual announcements or rules as they change. The difference this time around is that the Labour government has actually said this is going to be a tough budget and we are going to see tax hikes. So it's slightly different. So we're going to cover what the speculation is about the budget. The second piece we're going to be doing is packaged bank accounts. Now, I was asked by a national newspaper in the last week to give them my view on packaged bank accounts. So I'm going to bring that to the podcast. And the last piece, Andy, is a really interesting piece that you're going to be doing on scams, but a particular new type of scam.
Yeah, so we're going to be covering AI voice scams. So Starling Bank, one of the biggest online digital banks, has been doing a bit of a campaign recently to alert people of the dangers of AI voice scams. So we'll cover that at the end of the podcast, exactly what it means. And actually, there's a takeaway there on what you and your family can do to keep yourself safe.
Yeah, and there's something really interesting to listen to. I'm not going to spoil it, but we'll come on to that at the end of the show. So I'm going to jump straight on to the predictions for the budget. As I mentioned in that intro, the difference this time around from previous budgets is that we've been told to expect some pain, i.e. there are going to be tax hikes. And the reason that I brought it to the podcast is that if there are going to be tax hikes and there are generally 2 key taxes that people are expecting to change, then if you are in the position that you might want to make changes to your finances, one of those tax hikes potentially is capital gains tax. So if you were thinking of actually crystallizing a gain in this tax year, then there is an argument that there could be a benefit of doing it before the budget happens. Now, I'm not one of those people that tries to encourage people to do anything based on speculation, but in a situation where we can be pretty certain that we're not going to get any new tax breaks and taxation going to go down, then it makes sense to think about if you are going to do anything like, as I mentioned, realise capital gains at some point in this tax year, that you could do that prior to the budget. So what I'm going to do is go through 5 key predictions, the ones that have gained the most weight, it seems, in the press and among experts. And you have to bear in mind that perhaps none of these will come to fruition, but it is interesting nonetheless to hear what people are saying. And sometimes I do think governments start to leak a few ideas and see how the market and the press and voters react. So on that note, one thing that we do know is that we're probably not going to see any changes to basic, higher or additional income tax rates. And the Labour government in their manifesto said they wouldn't change those things. We're not going to see changes to national insurance apparently or VAT, and corporation tax will be kept at its current level. Of course, we could see changes to those, but they were key pledges in their manifesto in the general election. The other thing is that we are going to see the introduction of VAT on private school fees. That's been pretty much confirmed. And of course, the other thing that we've already heard is that there are going to be changes to the winter fuel payment. In fact, it's going to effectively be means tested. So I'll put a link in the notes to the news story that we previously wrote on that. Again, there could be changes, but it is in all likelihood going to happen. So the first prediction out there that's gaining some weight is that we could see changes to capital gains tax rates, and they could be aligned more with income tax rates. So at the moment, basic rate taxpayers will pay 10% CGT rate above their allowance of £3,000 a year. Now, 40% income taxpayers, they pay a CGT rate on profits above that annual allowance of 20%. Now, having said that, there is a slightly different rate for residential property. We're not talking about your main home, but property. It's 18% for basic rate income taxpayers and 28% for taxpayers that pay 40% income tax or higher. So that out of the way, there is speculation that they could actually align the CGT rates more with income tax rates. So, for example, if you are a basic rate income taxpayer, going forward, you could end up paying 20% CGT rates rather than the current 10% CGT rate. So effectively doubling the tax that you would pay on any capital gains above your annual allowance. So there are numbers that have been calculated on how much that could actually raise for the government. It could raise as much as £14 billion a year. So that is why there is speculation that that might occur. If you're an additional rate taxpayer and there were changes put in that would more align CGT rates with income tax rates, then you could see tax charges of more than £21,000 on a £50,000 capital gain. So let's say, for example, that was an investment outside of a tax wrapper. So going forward, tax wrappers and ISAs are going to be ever more important. And there's been a lot of people making sure they're using their allowances before this particular budget. So that is an example of if you were going to release a capital gain, that some people have been doing it before the budget rather than waiting to after to see what happens. Now, I'm not telling you to do that because obviously we don't know what's going to happen, but it is a slightly unusual scenario that we're in where the government has told us to expect pain. Now, the second potential change that people are talking about is that the capital gains tax could be brought in to create a double death tax. So when somebody dies, there could be capital gains tax applied to the gain on the asset before they enter their estate, to which they can then actually have inheritance tax applied to that estate as well. So creating a double taxation. So at the moment, what happens if you owned an asset and it increased in value over your lifetime, if you die, then there is no capital gains tax on that growth in that asset, the profit that you've made. Now, obviously, if you'd made a capital gain on that asset during your lifetime and you'd sold it during your lifetime, then you are liable to capital gains tax on the profit. But when you die, that doesn't happen. So there is no capital gains tax to pay. The assets go into your estate and then it's assessed for any inheritance tax liability. We could potentially have the scenario now where capital gains tax is applied on death and then you end up having to pay inheritance tax, or your estate does, after that capital gains tax has been applied. So at the moment, the government foregoes about £1.6 billion in tax a year by not applying capital gains tax on death. Now, this could be very unpopular, but in reality, it's probably going to impact the wealthiest in society. So it might be a little bit more palatable, deemed to be, by the government. The next prediction, so number 3, is a potential change to pensions. Now, we always hear about changes to pension, and they never really tend to come to fruition all that much. Now, the tax-free lump sum could be reduced. So at the moment, you can withdraw. We're talking about a defined contribution pension here. You can withdraw up to 25% typically of your pension fund tax-free as a tax-free cash lump sum, up to a limit of £268,275. So that's obviously once you get to age 55. Now, there is speculation that they could reduce that limit down to something like £100,000. Now, that could raise about $2 billion a year in the long run. If they did that for that particular number, then this is based upon analysis by the IFS. So that would be very unpopular. And one thing you've got to think about, there are lots of people out there who've made retirement plans and have funded their retirement based upon the rules as they are now. I know that rules do change when it comes to pensions, but it would be incredibly unpopular and actually could cause problems for people's retirement plans if they were to make these changes. So if they did make any changes, they might not be retrospective. It could be going forward that they create these changes. So that is one possibility, but again, that creates a bit of a headache. The next one, which I think would actually create a really big administrative headache, is if they did a flat tax relief on pension contributions. So this has been floated before. So at the moment, you get tax relief on pension contributions at your highest marginal rate. Now, there are obviously the annual allowances for pension contributions, which will be, at the moment, it's the lower of £60,000 or your earnings. And if you are a non-taxpayer, then you can actually put in £2,880 a year net, and you get 20% tax relief on that. That's how much you could put in a year. They might decide to do a flat rate of something like 25%. That's one idea that's been floated. So that means that everybody gets just 25% tax relief on their pension contributions, which obviously means pensions are less attractive to the wealthiest, because the wealthiest in society at the moment get the greatest amount of tax relief. That, again, could prove unpopular, and it would also be quite difficult to implement in the case of salary sacrifice. So salary sacrifice is where people effectively can pay into pensions out of their gross salary. That has benefits. For example, it can create national insurance savings for employees and employers, but it is one way you can fund a pension from your gross salary. But that would then mean that they've got to try and work out, if they had a flat rate of tax that was different to the income tax rates, how would they implement that? Because, for example, if it's 25%, if you pay via salary sacrifice and you're getting tax relief effectively at your highest income tax rate, then how would they implement the difference? Would they have to apply a charge? It gives me a headache just thinking about it. So that might be an issue. They might have to try and create a workaround of some kind. So we could see a flat rate of income tax relief being applied. It wouldn't be popular. The other danger is, and I know this will be for some people listening to the podcast a bit of a, well, boo-hoo, let's get the violins out, but it would make pensions unattractive to the wealthiest people in society, which could create a problem in the future for people not putting enough away in their pensions for their own retirement. So moving on to the final prediction, pension funds could be included within your estate for inheritance tax purposes is an idea that some people are talking about that could be included in the budget. Now, that's quite radical, because at the moment, if we talk about defined contribution pensions, if you die under the age of 75, then generally speaking, there isn't any inheritance tax to be paid on the pension if people inherit it. And also, if they withdraw from it, there is no income tax to be paid either. If you're over age 75, then they would have to pay income tax on any withdrawals from the money that they inherit. So that is going to be a big shift away from that regime. Now, that again could be very unpopular. And if they applied it, because people have obviously been planning for their retirement and also for inheritance, it could be something that would be applied retrospectively. Now, this is an idea that I've heard a number of people mention and seen in the press. Again, if it's not applied retrospectively, then what they might have to do is create one of these protection regimes. We've had it in the past with pensions, where if you register and you've had a pension before a certain date and benefits, etc., then it won't apply to you. And this creates another layer of complication. Don't forget, we had the lifetime allowance and that charge removed previously. So that was something that people liked because that added a layer of complexity. Is this going to just add another layer of complexity? So there are 5 predictions that could be in the budget. Probably none of them actually will be, but it is seemingly inheritance tax and capital gains tax that people are most concerned about that are going to be targeted in this particular budget coming up. But as I mentioned at the start of this piece, it doesn't mean that you should go and make changes to your situation or hash in your pension lump sum to withdraw from it because you're worried about taxation. You should always seek advice before you do anything. But that is the speculation that we've got at the moment. And it does seem to be whatever is going to happen, that we're probably all going to be worse off in terms of taxation.
Yeah, that's a really good piece, Damien. And don't forget, we will be doing an update on the podcast later on into October when we actually do finally know what is going to be happening within this autumn budget. One of the things that I just speculate, Damien, is how much do they actually speak to the relevant authorities and providers on what may be coming? Because to me, like you said already in this part of the podcast, a lot of it is headache inducing, and there seems to be a lot of pain for all sorts of people, employers, providers, and the like.
Yeah, and I think that's exactly what happens, and they don't want to create a huge headache. But even if they do announce things in past budgets, what often happens, you'll sometimes see in the budget, if you ever download the budget, because you can do that, I don't know if people realise that as soon as the budget is announced, as soon as the Chancellor sits down, you can go online and download the official budget and read it for yourself and find the details. That's what we do at Money to the Masses. That's what every journalist out there does. And you can see whether things are going through a period of consultation. So even if they announce them, then they could say there's going to be a period of consultation to see how they're implemented. So a good example of that was the British ISA that they started to announce. There's going to be a period of consultation, and it was effectively now just completely fallen apart and is not going to happen. So it's going to be interesting. 30th of October is the date for your diary, but we will be doing stuff on the podcast and the socials, and of course we'll be publishing content in our newsletter and the Money to the Masses website.
Okay, so let's move on to the next piece of the podcast then. And Damien, we're going to be talking about package bank accounts because you were approached by a journalist in the week to provide your insight into package bank accounts and whether they provide true value.
So I was approached by The Guardian to give insight into packaged bank accounts and whether they offer good value. And actually, we write about every type of financial product out there, so people won't even realise that we've got analysis on the Money to the Masses website of the best packaged bank accounts. Now, if you are watching this on YouTube or via Spotify, you can watch video versions of the podcast now. I'll show on screen some of the things I'm going to be talking about, but also link through to the article in the notes of the show so people can look at the simplified tables that we've got that actually show the benefits that a lot of the top packaged bank accounts have, and so you can compare them quickly. But the thing is, in the past, packaged bank accounts have been one of those products that have been pretty poor value for money, and they're a way for banks and building societies to make a decent amount of profit. So they package a bunch of products and services together, things like travel insurance, and then charge you for the account. People would never use the products, and they'd end up making decent money out of the customers. I'd have to say the world has moved on quite significantly, and that's due to competition, but also because we're seeing a lot of the new app-only banks. So people like Monzo, for example, who have entered this space and come up with slightly different types of perks that probably are a little bit more attractive to certain parts of the population. So what I want to do is mention some of the packaged bank accounts out there so people go and look at them, but just give some general tips and advice that people might not realise that they should look at if they are attracted to packaged bank accounts. So like I've said, in the past, it was generally avoid packaged bank accounts, but now I think some of them have actually offered some good value. So I'm going to jump to a table on the article that I mentioned earlier about the best packaged bank accounts. If you're watching this, you can see the article in question and the table, but if not, it will still work by listening to the audio of this. And we'll put a link to the article in the notes of this particular show. So there are a range of providers out there. So Co-op, Halifax, HSBC, Nationwide, NatWest, Virgin Money, as I said, Monzo, even Revolut, even though they're not a UK bank at the moment. They've got their banking license, but they're still not officially a UK bank. They've all got packaged bank accounts that you can look at and see the various benefits that they offer. Now, typically, they'll offer things like travel insurance, breakdown cover, mobile phone insurance. Some of them offer home emergency cover. So things like if your boiler breaks or your windows smashed in your home, they'll cover the cost of having that fixed up to certain amounts. And there are a range of other benefits. And Monzo has been innovative. You can get a Greg's sausage roll every week if you want. So there's a whole range of packages out there. Now, typically they range from, say, 13 to 20 odd pounds a month. As an individual, you need to go and look at the perks and benefits of any packaged bank account out there and look at whether you can actually get them cheaper by shopping around. Now, I've looked at a number of these bank accounts, and some of them are actually offering some pretty decent packages. So, for example, Nationwide was one of the popular ones because it actually has an account that's only £13 a month. It has free spending abroad, offers travel insurance, breakdown cover, and mobile phone insurance. Now, at £13 a month, if you're a regular traveller, that could be really cost effective. The one issue is that that cost is going up. So this is what sparked the initial story from the journalist. That cost a month is going from £13 to £18 later this year. So £18 a month, is that still going to represent good value? Now, I would argue if you're getting value for money from £13 a month from this particular account, you're likely to still get value for money at £18 a month. And one thing to point out is that for this particular account, the cost hasn't risen since 2017. Now, every cost that I know, whether it's any type of insurances, for example, or bills that you have at home, have rocketed in recent years. So that is why the cost of the account is probably going up, but why it can still potentially offer value for money. Now, I'm going to jump on one of the benefits generally. Travel insurance is probably the most popular benefit you get with a packaged bank account. Now, as somebody who has a pre-existing medical condition, I mentioned my Crohn's at the start of the show, packaged bank accounts don't generally give any value for money for somebody like me. And that's because there's usually a caveat that says that if you have a pre-existing medical condition, it will be excluded from the free travel insurance that's included in most of these packaged bank accounts. You technically can get it included, but you have to contact the insurer of the travel insurance, so the provider of that that's associated with the packaged bank account that you are looking at. You might have to have some sort of medical questionnaire to see if it can be included, but typically you'd have to pay an additional premium. Now, the issue with that is that it will therefore increase the cost of the packaged bank account overall. But if you're somebody with a medical condition like I am, shopping around and using specialist insurers is the best way to get the most cost effective and best coverage for your particular condition. So there are companies like, for example, StaySure. I will put a link in the notes to an article on the best travel insurers for people with pre-existing medical conditions. We've got that on the Money to Masses website and we update it regularly. So that's one thing to bear in mind. The other thing with something like travel insurance, make sure you know about the age exclusion. So it can get to a point where if you're above a certain age, you won't be covered under the insurance. So there are people who will be having packaged bank accounts that think they are covered when they are not. And the other thing, and this is a general rule of thumb to do with any benefit that you have on a packaged bank account, make sure you know who is covered and who is not. So some packaged bank accounts, you can take out obviously as joint accounts and therefore both people on that account are covered. Some will extend the coverage to the whole family. Others, it will just be the sole person who is the holder of the bank account. So you need to make sure whether a perk is extended to your family if you want that. Good example is Monzo. So Monzo's benefits, I'll talk about some of the benefits on some of the accounts, but Monzo's account, you have to pay an extra £5 a month if you want the benefits it provides extended to your wider family. So it can go up to a family of 4. That adds to their cost on their top tier. So they have a range of packaged accounts effectively, but the top one is £17 a month. So you'd have to add another £5 on top of that to have the benefits extended to the whole family. So Nationwide, I mentioned their Flex Plus account, £13 a month. It's good for those people who are frequent travellers. Now that they are upping the cost of that, people probably will be attracted to something like the Virgin Money Club M account. That's £12.50 at the moment. One thing I will point out actually is that even though these costs I'm mentioning have been pretty static, I wouldn't be surprised if some of them start going up now that Nationwide have announced the increase to their monthly fee, because I think the others are going to probably end up following suit to sit in the sort of similar position in the market. Once Nationwide have set the new price point up towards £18 a month, I think some of the others will likely move as well. So Virgin Money's Club M is probably an alternative if people want similar benefits. So it offers travel insurance, breakdown cover, and mobile phone insurance. It actually offers gadget insurance to the wider family as well, which is something the nationwide account doesn't offer. So gadget insurance is something that I think some people now are attracted to. If you want home emergency cover, most package bank accounts don't actually offer that, but Halifax have an ultimate reward current account that's £19 a month that does offer home emergency cover. Again, go and look at the T's and C's. I've looked through them, and what this is, it's effectively a cover that if there's an emergency in your home, so like a broken window or a burst pipe, something that's going to impact the safety and security of your home and potentially the health of people who are living in it, then that can be covered up to an amount of £250. And what they do is the insurance that's provided with it, they will actually send somebody out. They'll find somebody to repair the issue and resolve it up to that amount. So it's slightly different to some of the other home covers that you have out there that you can buy as separate insurance products. People like British Gas, for example, offer them. But that could be something that could be attractive to people, but you have to look at those T's and C's. It's slightly odd because it does give an example in the general blurb about your central heating not working, but when you go into the T's and C's, it doesn't give a very good example about how that actually works. So do make sure you understand what you will be getting and what you won't be getting. There are other accounts out there. So HSBC's Premier account, that gives travel insurance, but the reason I wanted to mention it is because there is a difference between a Premier account and a package bank account. So package bank accounts are things where you pay a monthly fee and you get perks and benefits. With Premier accounts, they give you benefits, but you don't usually pay for them because they are reserved for the bank or building society's wealthiest customers. So there's usually an eligibility criteria. The HSB Premier account, you have to earn over £100,000 a year and have that money paid into one of their accounts, or have more than £100,000 in savings in one of their accounts. So it's effectively for the wealthiest customers out there. In a roundabout way with Premier accounts, you're effectively paying for those perks, aren't you? Because they are going to make money off you in the long run. So I'm not going to go through all of the things that are covered on all of these policies, because it would be slightly tedious for the people listening to the show, but you can go and look at the article on the Money to the Masses website. The thing to think about on the breakdown cover that's included on these accounts is check who is covered, whether it extends to your wider family, so your partner, for example, if they're driving, but also the type of cover, because with things like AA and RAC, they will often have different types of cover, so different tier. So one of them, for example, could be breakdown cover, which is when you're away from home. And so let's say you're driving on the motorway and you break down, they will come along and they will try and repair your car, but they won't necessarily take you onward to your destination. So some policies you can pay more, for example, with the likes of AA and RSC, to have onward journey cover. So they will take you to your destination if they can't repair your car. And they also can have an additional benefit, which you have to pay more for, where you can have home start. So let's say you wake up in the morning and you go to start your car and it doesn't start, they'll come to your home and try and fix your car. So standard breakdown cover doesn't have the onward journey part or the home part. And when they say home, they normally have about a mile exclusion zone around your home. So you can't just wheel it off the drive, for example, and say, I broke down. They're pretty wise to that kind of thing. So do make sure when you've got a package bank account, you know the level of breakdown cover that you are getting. So you might be giving up something that is a better tier or better level of cover for something on a package bank account that isn't going to give you what you want. So they are some of the things to bear in mind when it comes to the app-only banks. Now, Monzo, I mentioned already, has a tiered structure. So there are different types of plans that you can pay for. The top one at £17 gives you travel insurance, breakdown cover, phone gadget insurance, but you also can get a free rail card every year. So those things are like the 16 to 25 rail card, for example. So different types of rail card you can get. They are typically about £30 a year. So you have to factor that into the overall cost and whether you're actually benefiting from the £17 a month fee. You've got that Greg's that I mentioned earlier as well. So the other thing that often with package bank accounts, and Monzo are one of the ones that do it, they might give you a better rate of interest on the money that you have saved with them. So Monzo, you can get up to 4.35% as I make the show now on certain amounts of money in the instant access savings pots that they provide. So do make sure you look at the perks. The thing is, always review your perks that you get and the rewards to make sure you're getting the most out of them. So with package bank accounts, it still remains the case that you should shop around, look at all the different types of package bank accounts, what they offer, whether you will use the benefits, whether you can buy the benefits cheaper yourself when you shop around. And also do make sure you check all the T's and C's on the benefits, because they do differ from bank to bank, and whether you'll be covered, for example, under the travel insurance. And if they don't provide value for money, and make sure you do check regularly, even if you have one, whether they still provide value for money and you're still using those benefits. If they're not, then don't pay to bank. You can bank for free in this country and buy the products and services that you need and use separately.
So, Andy, this next piece we're going to be talking about AI voice scams and just how dangerous they can be. Now, you can probably tell that I sound a little strange, and that's because I never actually said these words. Using some basic online software, Andy has created this intro. Don't worry, I gave him permission, but it shows just how easy it can be.
So there we go. Thank you for introducing that piece, Damien. But as that piece of audio just described, that wasn't actually you. So, Damien, that's quite scary, isn't it? Listening to yourself back.
Yeah, see, that is just shows that you can get something that's fairly convincing. And the point is, when you have a voice you're expecting at a certain point in time, like on this podcast, then you might think it's odd, but you probably wouldn't twig initially.
Yeah, so that's the whole reason we brought this piece to the podcast, because Starling Bank have been on a bit of a campaign in recent days to highlight the awareness of AI voice scams, because they are on the rise. Now, I use some pretty basic software, and that took me less than 3 minutes to create that and upload it into the podcast. But of course, fraudsters will have access to much more capable software that is more advanced, and it is very realistic indeed. So, Damien, I'm just going to play out a brief video on the podcast here for people who are watching it, but the audio listeners will get an idea of what's going on, because, again, this is from Starling, so credit to Starling for this piece. It is James Nesbitt that's been introduced to AI voice scams and exactly the power of it. So I'll play it out now.
Can I get that? Hi, thank goodness you picked up. I really need a favor. Yes, very good. But yeah, I need you to send me your PIN number. It's kind of urgent. What is going on here? I mean, I haven't said that. Look, I wouldn't normally ask, but I really need a hand here. Can you just help me, please? Look, what is going on here? Listen, that's my voice. That is my voice. Why do you keep saying that? I think you'll find it's my voice. What? What is going on? Have you cloned my voice? Who are you calling a clone? Here, I can prove it's me. I know that Peggy's favourite dinner is my bacon pasta. that is true, Pegs. Peggy, are you hearing this? Is somebody, you can hear it? What's the matter, Jimmy? Getting cold feet?
Okay, so I'll cut the video there. You get the idea of what's happening. That is James Nesbitt that's being effectively shown how voice cloning can work in terms of voice scams. I mean, it's pretty convincing stuff, right?
I mean, that is incredible. If you see the whole video, it is really impressive, because the AI is getting so sophisticated now. So like Andy showed earlier with just doing a bit of my voice, they can create voices, but also we're at the stage where already they can create video as well. So it's important that people understand the scam and what can happen, because they could do it for anybody, anything, friends, family, and particularly obviously people who are out a bit more in the public domain. Martin Lewis has had various scams, and so people have to be mindful of anything they hear and see. They have to not necessarily believe, and they have to be distrusting of it. And of course, as in that particular clip with James Nesbitt, if they have some information, that can make it even seem more convincing, because they will tell you something that you think they might not know. So you're going to go on to some tips of how you can try and avoid falling victim to something that is an AI voice scam.
Yeah, so essentially the first tip really is just be really careful about what you're sharing out in the public domain, because as we saw there in the James Nesbitt example, his favourite bacon pasta was, or whatever, was an example there. That's obviously been taken from something that's been posted on a social media clip, and that is vital information for fraudsters, because then they can put that into their online AI prompts and script a certain scenario whereby that will make it more convincing. So just be careful of what you're sharing in terms of pet names, family members' names, middle names. And so the second tip, and really the takeaway from this part of the podcast, is for you and your family to consider creating a safe phrase. Now, a safe phrase is something that only you and your closest family members and friends as well would know, and you can share amongst yourselves. And that's not available in the public domain. And this will ultimately break this AI voice cloning software, because how would it ever know what this safe phrase can be? Now, there is no limits to what that safe phrase could be. It could be your favorite line to a movie. It could be a nickname that you call each other that you're actually embarrassed to share in the public domain. That's always a good one.
Yeah, and you have to bear in mind that, think of this like a bank. So banks for a long time have had voice passwords, and they'd ask you for certain letters from your passcode, so you didn't actually tell the operator what it was at any moment. So that has been around for years, as soon as telephone banking became a thing. So it's kind of taken some of that on board and using that personally. So people had a voice call and you weren't too sure, then you had that phrase. I know it does seem a little bit crazy and a little bit, for some people, they might think it's a bit much, but this is the world that we are now moving into very rapidly. And so it's better to be safe than sorry.
Yeah, and really, this is one stage on from that WhatsApp scam that we highlighted on the podcast a little while ago, actually, about that. Hi, mum, or hi, dad, help, I'm in trouble, I've lost my phone. That's a fairly low-tech scam, which basically plays on your emotions as a parent, as a friend, as a family member, to help out someone in trouble. This is one stage on now, so do be aware and do be careful. It is a thing. So, Damien, we are done. That is it for this week's podcast. Please do review the podcast in the usual way. Wherever you listen to the podcast, give us 5 stars and share it, and tell people about it as well, because it helps us to spread the word. Do check it out on YouTube and Spotify, our video versions of the podcast, because we're trying really hard to make this more visual for people who do want that. And obviously, we are sharing lots of shorts from this particular podcast on our socials as well, so you can get bite-sized pieces of the podcast.
Yeah, so do make sure you follow us on all our socials. So Instagram, TikTok, obviously, as Andy said, YouTube. Go join our Facebook group, facebook.com/group/money to the masses. And if you've not done so already, do go into our Facebook group and sign up to help road test our app I mentioned last week. So we're wanting people to volunteer to help us, and you can get a Money to the Masses mug for doing so. So Andy, I think that's it for this week. And as usual, all we've got to say is until next time.
Until next time.